The world of enterprise AI is changing so fast, it's frankly dizzying.
It really is. And every major software company out there is trying to pull off this high-stakes mid-air pivot.
And we have managed to capture what might be the definitive case study for this very transformation. Today, we are deep diving into 6 full quarters of data. We're talking September 2024 all the way through December 2025.
That's right.
And we're charting the dramatic, high-stakes evolution of a major player in the space, C3 AI.
Yeah, and this isn't just about looking at a few headlines. We have a detailed year-and-a-half view that we've pulled directly from their investor supplemental reports.
So that's Q1 through Q3 of fiscal 25, and then Q1 and Q2 of fiscal 26.
Exactly, a proper longitudinal view.
So our mission for this deep dive is to really track this company's journey. It starts with this period of rapid revenue acceleration.
Then moves into this massive multi-year strategic alliance building.
Right up to a critical and very sudden leadership change.
And the fallout from that, the sharp financial contraction, and really a total organizational restructuring.
We're looking for the clear signs of a business model that's trying to adapt in real time to the generative AI revolution.
And these documents, they let us see how the core indicators, revenue, gross margin, and maybe most critically partnership metrics, how they all reacted. It's like a roadmap of corporate survival.
Okay, let's unpack this. Let's start at the beginning, the period we're calling the peak of acceleration. This is the first half of fiscal year 2025.
Right.
Looking back at the end of calendar year 2024, the picture for them looked incredibly healthy, a huge turnaround.
Incredibly healthy is the perfect way to put it. The speed they were accelerating at was, well, it was notable.
So how fast are we talking?
Okay, so total revenue growth, it was climbing fast. It jumped from a, pretty modest 11% year over year in the prior year's Q1
Okay.
to 21% in FY25's first quarter. That's about $87.2 million. And then it actually peaked.
It got even better in Q2.
It did. It hit 29% growth year over year in Q2, reaching $94.3 million. I mean, that acceleration curve is exactly what investors want to see.
And crucially, this wasn't just lumpy services revenue, right? The core of the business, the subscriptions, that was also strong.
Very strong. Subscription revenue growth was holding steady at 20% in Q1, and then it even ticked up a little bit to 22% in the second quarter.
That kind of consistency gives you a lot of confidence in their recurring model.
And from an operational standpoint, their efficiency was, well, it was stellar. Their non-GAAP gross margin held consistently strong at 70%.
70% in both Q1 and Q2.
Both quarters. And
Yeah.
just to break that down for everyone listening, that number, non-GAAP gross margin, it tells you how efficient a company is at delivering its software and services before you factor in all the sales and admin costs.
And hitting 70% is a benchmark for mature, highly efficient software companies.
Absolutely. That 70% figure just screams operational maturity.
They were also pointing to some major customer validation. I saw they cited an NPS score of 61.
Yep. And they benchmarked that as the highest among their listed competitors at the time.
So revenue's accelerating, efficiency is high, customers seem happy. What was the tactical engine? What was actually driving this surge?
It was overwhelmingly the ecosystem. The entire growth engine was being fueled by external partnerships.
Really? How much of it?
In that first quarter of FY25, 72% of their total agreements.
Okay.
So that's 51 out of 71 total deals
Wow. 72%.
were closed through their partner network. If you look at that year over year, that is a 155% increase in deals closed through the channel.
That's staggering. I mean, if over 2/3 of your business relies on third parties, that channel becomes the single most important asset you have.
And they knew it. The details on the Google Cloud Alliance really bring this home.
Okay.
In that first quarter alone, Google Cloud and C3 AI jointly closed 40 agreements. That was a 300% increase year over year.
300%. That's the kind of co-selling and co-marketing that lets you scale so much faster than just hiring your own sales team.
Exactly.
And these weren't just small deals, right? They were highlighting tangible, real-world value.
Right, there was that quote from Shell. They were using the C3 AI reliability suite, and they specifically noted they could get a much better handle on their control valve conditions.
Which directly translates into saving money and improving industrial performance.
That's it. That's the core, tangible value proposition of enterprise AI that was fueling all this initial growth. And it leads us right into our next segment.
The strategic alliances and the big generative AI focus right in the middle of FY25.
They realized they had to move past just short-term deals and lock in some long-term structural distribution.
And that structural distribution came in the form of the Microsoft Alliance. This was established in the second quarter, and it was. It was massive.
A huge deal. C3 AI became a preferred AI application provider on Microsoft Azure.
And this came with a joint sales and marketing engine, and critically, commissions paid directly to Azure reps for closed deals.
This wasn't a handshake. This was a 6-year marriage, basically, running from October 2024 to March 2030.
That deal just solved their distribution challenge for years to come. It gave them access to Microsoft's entire global enterprise client base.
And the momentum was immediate. By the third quarter of FY25, they had jointly closed 28 agreements with Microsoft across 9 different industries.
And that represented what was the growth figure?
It was an astounding 460% increase quarter over quarter, a direct result of that new strategic framework.
Okay, so they built a distribution channel. But how did that partnership growth align with their actual product strategy, especially as the market started screaming for generative AI?
The product strategy centered entirely on one word:
Trust.
trust.
Okay.
They weren't just trying to release the fastest chatbot. They were aiming for a high-assurance, enterprise-grade generative AI. In Q2, they were awarded a key patent for AI agents.
And what did that patent cover?
Well, if you look at the tech, it highlights things like an AI orchestrator, autonomy. But the most crucial parts for enterprise customers were traceability and security.
And why is that focus on traceability and security so important in an enterprise context?
Because in high-stakes environments, think defense, aerospace, critical infrastructure, you can't have a black box AI that just spits out an answer.
You need to know exactly how it got there.
Exactly. What data it used was the process secure. That patent really confirmed they were positioning themselves for the most complex, high-stakes customers.
And that goal of global scale and high assurance, that was really underlined by their alliance with McKinsey and Company in the third quarter.
Absolutely. This alliance essentially connects the technical platform with the human capital you need to deploy it globally.
So it combines McKinsey's quantum lab expertise with the C3 AI platform.
To deliver what they called high-assurance AI-powered digital transformation at global scale. When you pair Microsoft's distribution with McKinsey's consulting firepower, they were building a pretty imposing moat around their ambitions.
We even saw it in their C3 Transform 2025 agenda, the speakers they had.
Right. People like former Secretary of State Condoleezza Rice, former Speaker of the House Kevin McCarthy.
That's a clear signal, isn't it? A strategic shift toward these complex, high-stakes areas like defense, geopolitics, high-level government contracts. They were aiming higher than just industrial optimization.
And this is where the narrative just hits this major inflection point. This takes us into segment 3, the organizational pivot.
In fiscal year 26, Q1.
Everything had been building toward this massive growth and expansion, but internally, the foundation was starting to tremble.
The seismic change came in September 2025. The CEO role transitioned from the founder, Thomas Siebel, to Stephen Ahikian.
And this was clearly more than just a routine personnel shift. It signaled an immediate strategic overhaul.
And we know a bit about the new leader's background. He had success scaling companies like RelateIQ and AirKit.ai.
Right, technology that now underpins Salesforce's Einstein and Agentforce.
And he has significant public sector leadership experience, too. He was acting administrator of the U.S. General Services Administration.
He pioneered AI adoption there. So you could argue this was a calculated move toward a public sector platform-focused future. But the immediate financial consequence, it was brutal.
Because at the same time, they restructured their sales and services organizations.
And the company immediately withdrew its full-year guidance for fiscal 2026.
That action alone just signals deep internal chaos, a complete lack of short-term visibility. It's the corporate equivalent of pulling the emergency brake.
It is.
So what was the immediate damage, the fallout on the income statement?
It was a sharp reversal of all that previous acceleration. Revenue dropped pretty significantly to $70.3 million in Q1 of FY26.
And to put that in perspective, that's down from, what, $87.2 million in the same quarter the previous year?
Exactly. A clear, sharp contraction. It completely halted that growth trend dead in its tracks.
And what about that highly efficient, that 70% gross margin we were talking about earlier? That must have taken a massive hit.
That's where the shock really lands. This is what reveals the depth of the organizational pain.
How bad was it?
The non-GAAP gross margin plummeted from that consistent 70% level we saw all the way down to 52%.
70. to 52%. That is a massive operational hit. What does a drop like that even imply?
It implies that the company's internal cost of delivering their software and support their cost of goods sold, it increased by almost 40% overnight.
So they traded their efficiency for something else.
They did. This suggests either incredibly high short-term costs from the sales restructuring, or a massive investment in enabling their partners, or a shift to a business mix that's just inherently lower margin, at least for now.
They sacrificed their margin for the speed of channel adaptation.
That's a good way to put it. And they immediately rolled out a new go-to-market strategy to accelerate that.
The C3 AI Strategic Integrator Program.
They did. And an analogy might help here. It's like they stopped being a retail store selling finished shirts.
And started being a fabric supplier.
Exactly. This new OEM initiative enables their partners, the ecosystem they spent years building, to license the core C3 platform and then build and sell their own enterprise AI applications.
It's a clear shift from selling end-user applications to selling the underlying development platform through partners.
A fundamental change.
Which brings us to segment 4, where we track the short-term recovery and the new identity that started to emerge in fiscal 26. Did the financials find any kind of stable ground after that restructuring?
There was a minor stabilization. It suggests the bleeding stopped, but it was nowhere near a recovery to where they were.
What were the numbers?
Revenue ticked up a little bit in Q2 to $75.1 million, and the gross margin saw a small bump back to 54%.
But the guidance.
The guidance for year-over-year growth in that quarter was still distinctly negative. They were guiding for contraction between 15 and 24%. The turbulence was far from over.
What's fascinating here, though, is the pivot in who is now buying. Amidst all this turbulence, the reliance on federal, defense, and aerospace became just absolutely dominant.
This is the definitive strategic pivot. In Q2 of FY26, that sector, federal, defense, and aerospace, it made up 34.5% of their total bookings.
And compare that to early fiscal 24, where that segment was only, what, 5.8%?
Exactly. It shows an immediate, decisive shift in focus. This higher security, higher stakes sector is now their strategic anchor. And that's reflected in the 89% year-over-year growth in federal bookings alone.
So if we connect this to the bigger picture, it suggests that the industrial growth that defined early FY25 kind of stalled out.
Ugh.
And the new leader, Stephen Ahikian, immediately pivoted to the public sector where his expertise lies.
And that anchor holds firm thanks to the partners. Despite the severe internal turbulence, the margin hit, the external ecosystem proved to be incredibly robust.
So the partner engine was still running.
In Q2 of FY26, a full 89% of total bookings were still driven with and through partners. The distribution engine, however painful to retool, was still working.
And we finally see the quantitative payoff of that huge Microsoft alliance, which had been in place for a year by then, right?
We do. They hit a major milestone. They announced that the Microsoft Alliance had generated over $130 million in C3 AI bookings in just the first year.
So that confirms that the channel leverage they built in FY25, it survived the restructuring of FY26, and it's still the most powerful driver of their top line.
It is. And to wrap up the quarter, they also got some external validation that their core industrial tech still holds up, despite the pivot.
Verdantix named them a leader in industrial AI analytics.
Yep, in 2025. They specifically scored highest in predictive maintenance for blending machine learning with physics and using LLM-assisted triage.
So they're actively juggling two major fronts.
Yep.
Leveraging their deep industrial tech while using their channel to capture these high-growth federal contracts.
So when we look back at this incredible 6-quarter period, what does it all mean? It was a rapid, dramatic, and very costly corporate transformation.
We saw that peak revenue growth, 29%, right in the middle of FY25, built on that strategic partnership engine.
Then the pivot, the Ahikian takeover, the Q1 FY26 restructuring, and the price for that change was immediate and severe.
Characterized by that sharp drop in gross margin from a healthy 70% all the way down to 52%.
And the company's response was to formalize that platform-focused strategic integrator program, the fabric supplier model, and double down on high-assurance sectors like federal and defense.
Which now drives the lion's share of their new bookings, all through those partners.
This entire deep dive just shows the inherent tension, the tension between rapid growth fueled by external partners and the unavoidable operational volatility you get when you try to restructure an organization mid-flight.
It's a really compelling story of prioritizing strategic realignment and future growth over short-term operational efficiency.
Which raises an important question for you, the listener, as you track this company going forward. They've successfully pivoted to this model centered on high-security federal contracts and a reliance on these strategic integrators licensing their platform.
Right.
Can the higher security and consulting margins, often associated with federal contracts, truly offset the increased cost structure and the potentially lower margins needed to support dozens of new integrators? What's it going to take for them to return that non-GAAP gross margin back toward that highly efficient 70% mark they achieved in the first half of FY25?
That margin metric really is the clearest operational measure of success for this new restructured business model.